Hello, and welcome to Arnerich Massena's second quarter MarketCast. We hope that you're enjoying the summer and taking time to reconnect with family and friends. And we've been doing the same, reaching out to reconnect with our clients and business partners. And if we haven't already, we hope to get together with you soon. Now, as we move past the halfway point of the year, we're happy to report that markets have continued to deliver remarkably strong returns. But the big question is, how long will this continue? In today's MarketCast, Research Analyst Melissa Liu and I will address the question by reviewing the market's risks and opportunities and sharing our strategies going forward. So now I'll turn it over to Melissa to get started.
Thank you, Ryan. In the second quarter, stocks rose to new highs as the global economic growth accelerated. U.S. large companies led the way, followed by international, emerging markets, and U.S. small companies. Bonds, which had lost ground in the first quarter, bounced back on signs that the Federal Reserve may start tightening monetary policy sooner than expected. And the U.S. dollar moved slightly lower on rising inflation and declining bond yields. And now, looking year to date, we're seeing that equity returns have been very strong in the teens, with U.S. stocks outpacing international and emerging markets. But there was also some unsettling economic news in the second quarter. In June, the U.S. Consumer Price Index, the CPI, rose 5.4% from a year ago, its largest annual increase since 2008. This upturn in inflation was partly due to the economy being on lockdown a year ago. However, supply disruptions, labor shortages, and rising demand were also contributing factors. But despite the rise in short-term inflation, bond investors continue to expect long-term inflation to remain moderate. Quarter-end bond market prices implied that investors expect 2.3 annualized inflation over the next 10 years. Now, as we head into the third quarter, investors are very focused on the question of whether inflation will stabilize and revert to normal, or will it become unstable and maybe even rise to a higher level? And it's a big question for a reason. When we look at history, we can see that stock returns have tended to be higher during periods when volatility of inflation was low. For example, in the 24 months leading up to July 1998, inflation was relatively stable and stock returns were strongly positive. However, during periods of volatile inflation, stocks have often disappointed, regardless of whether inflation was high or low. For example, in the period of volatile high inflation leading up to September 1974, stocks fell by 21.5% annualized. And in the period of volatile low inflation leading up to February 2009, stocks fell by 26.1% annualized. So clearly, volatile inflation is a potential concern. But inflation is not the only challenge facing the market right now. As stocks set new record highs for this quarter, market valuations are also becoming an increasing concern. In this chart, we can see that historically, the 10-year return outlook for U.S. large-cap stocks has been best when starting valuations were low. For example, when the cyclically adjusted price-to-earnings ratio, or CAPE, was between 5 and 12, stocks returned an average of 14.6% annualized over the next decade. However, when the CAPE ratio was in the range of 21 to 43, stock returns averaged only 4.2% annualized over the next decade. Unfortunately, as of June 30th, the CAPE ratio for U.S. large-cap stocks was 37, near the top of its historical range. This raises the possibility that despite their recent strong returns, U.S. large-cap stocks may disappoint investors over the next decade. So, what can a stock investor like yourself do? Well, fortunately, not all stocks are as expensive as U.S. large-cap stocks. In this chart, we can see, relative to the United States stocks, international equities are now at their cheapest in history, raising the possibility that international stocks will outperform over the next decade. Some past low points in international valuation include April 1971 and January 2002. In the decades following those bottoms, international stocks outperformed U.S. stocks by 8.5% and 3.1% annualized, respectively. So it's our view that international stocks are an opportunity in this market environment. And for many investors, private equity can be a great investment choice for 3 reasons. First, the private equity opportunity set is exceptionally broad. Private-owned companies make up over 80% of U.S. firms with over $100 million in revenue. Second, private equity as an asset class still has a lot of room to grow. Private equity assets under management remain relatively small compared to the global public stock market. And finally, in recent years, new investment vehicles such as interval funds have made private equity available to people who may have not been able to access private equity before. So please ask your advisor if this might be you. Putting all of this information together, how do we think that portfolios should be positioned going forward? Well, to answer that question, I'll hand it back to Bryan Shipley, Chief Investment Officer and Senior Investment Advisor, who will share our thoughts about portfolio positioning.
Thank you, Melissa. From a big picture perspective, we're seeing that since the market bottom last March, global equities have climbed over 90%, their strongest recovery on record. And this powerful stock rally has tended to drive many portfolio asset mixes away from their targets. And whenever a portfolio's asset mix moves away from its target, we think it's a good time to pause and think about rebalancing. Now, rebalancing a portfolio, selling overweight investments and buying underweight ones can provide two important benefits. First, it can keep the portfolio's level of risk steady over time and within your comfort zone. Second, rebalancing essentially is a buy low, sell high strategy that can potentially produce better risk-adjusted portfolio returns. So setting aside other considerations such as taxes, we think this can be a good time to think about portfolio rebalancing. And in this current market environment, when we consider rebalancing portfolios, we'll also factor in our tactical views. For instance, given the uptick in economic growth and inflation, we think it's going to be difficult for traditional bonds to add value. So instead, we're steering portfolios towards hedge and diversifying investments, although we'll continue to use bonds for liquidity and rebalancing purposes. Looking on the growth side, we're emphasizing small caps, international, and emerging markets, areas that we think are well positioned to benefit from a continued global recovery. So bottom line, as we move into the third quarter, we'll be looking to identify and take advantage of thoughtful rebalancing opportunities. We'll also continue bringing you new investment ideas in the months to come. Your advisor will work closely with you on specific opportunities as they become available. We're also pleased to announce that Arnerich Massena has been named a finalist in the prestigious Wealth Management Industry Awards for our philanthropic advisory services. This year, wealthmanagement.com had a record number of more than 900 nominations from over 300 companies, and we're very excited to be among the finalist honorees. The award ceremony will be held in New York on September 9th. Check our website for award information and updates. Thank you for joining us today, and enjoy the rest of your summer.